In the meantime, minutes from the July meeting of the Federal Reserve reflecting a rather divided central bank, one that is worried about tariffs and inflation, and another one also worried about jobs and the labor market. Let's tie it all together and get reaction from Mike Schumacher. He is the head of macro strategy at Wells Fargo Securities. Mike, good to have you on.
Thanks, Brian.
So the minutes today, which are normally pretty boring, let's all just admit that. Today they were not, because on one hand, it was a Fed that was saying, well, tariffs may drive inflation. That says to me, why would you cut rates? But on the other hand, they also said, worried that, tariffs and AI are going to hurt jobs. That's a case for a rate cut. How do you read the Fed right now?
You know, it's interesting. There was a lot of talk, and I think the big takeaway is more committee members are concerned about inflation and unemployment. But you had two dissents by governors, first time in 30 years. So very clearly an unusual circumstance for the Fed. I think Jay Powell's trying to pull this together and say, look, can't we all just row in the same direction for a while? But the problem is the whole tariff thing is very tough to assess. In the developed world, in the U.S., there's very little experience with tariffs. No one's terribly confident about modeling them, not the Fed, not us, really nobody. So it makes it a really tough call. So Powell said consistently he wants more data, he wants to wait. That really increases the chance they wait too much.
What he says matters. The speech matters. I think it's 10 o'clock Eastern time on Friday. That said, how much does it matter, Mike? Because number one, he's kind of a lame duck. He's going to be out in about 8 months. So it's kind of like hard to gauge how relevant this is. But number two, if we get a 25 basis point, 0.25% rate cut, and then no talk of more rate cuts, does that matter to the market?
It does matter to the market, and here's why. Let's say that Powell comes out, not Friday, but SEP 17, Fed goes 25. He takes the podium at the press conference and says, well, look, we're not going to do this too many more times. Trust me. Nobody's that good a salesperson. The market's going to say, hey, guess what? Now we have an easing cycle. They're going to be more, 2, 3, 4 more rate cuts, whatever the number is. We in the market will price more of that. Bonds will run, equities do well. I don't think Powell can really put that genie back in the bottle. The Fed may turn out to only do one cut, but that's not the initial market move. It's a big rally.
Michael, let's go to Europe for a second. ECB rate cuts. German bonds are at like 30-year high. I mean, you have rate moving to the upside. Germany, Italy, Spain, Japan on the other side of the world. But without question, there are things happening that rate cuts are not solving for. Thoughts on that?
I agree. Basically, Guy, it's the tale of two bond markets. So you think about, you can draw a line, write down 5, 7-year points, something like that. 5 years and in, bonds look pretty good. And that's the part of the curve that's driven by central banks. The long-term rates, they're driven by fiscal policy. U.S., massive deficit. Germany spending more money on defense. Italy, profligate. All those things are bad for long-term yields. So there's effectively a buyer strike right now on 30-year bonds. Is it healthy? No. Can the Fed fix it? Probably not.
So you talked about the thing that was most important was the talk about interest rates, or I'm sorry, inflation being a little higher as opposed to the labor part. Do you think that that's what Powell is going to focus on Friday?
I think on Friday what he'll talk about, Karen, is basically go through all the challenges and the accomplishments the Fed's had since 2018. That would be probably the right thing to do. He'll also talk about the Fed's new 5-year framework. They had this thing called average inflation targeting. No one really understood what it was. The Fed didn't describe what the averaging really was in terms of the time frame. So get rid of that. Good riddance. I suspect he'll talk very little about policy for the next few meetings. If he does, the market will react in a big way. So I suspect that gets very little airtime. But if I'm wrong and if he opens the door, it'll be a big reaction.
So, Michael, tell me why Treasury Secretary Bessant is wrong with his simple analysis. He's got intricate analysis, but the simple analysis that Fed funds rate is about 60 bips or so higher than, actually it's less now, but higher than the 2-year yield. And that's, the Fed says that they're moderately tight. He says that they're more than moderately tight.
I think it all boils down to what's the neutral rate. And the Fed doesn't really know with a lot of confidence. The Fed has told us it's 3%. I suspect that number probably goes up. The Fed's going to introduce its new number on SEP 17. Maybe it's 3 1/8, maybe it's 3 1/4. My colleagues at Wells Fargo on the economics team think it's a little bit higher, 3 1/4, 3 3/8. But the point is, the market's priced for about 3% at the end of the cycle. This is an easing cycle. In an easing cycle, the terminal rate's supposed to be way below neutral. That's the whole point. It's not there yet. So I would say that right now policy is somewhat tight, But the reason it's tight is the Fed doesn't really know with a lot of certainty what that neutral number is. So think about it. If you knew with absolute certainty it was 3%, you'd say, great, we'll be right on the screws. But if it could be 275, it could be 350, you can't go as quickly. And I think that's why the Fed's been reluctant.